This morning, winners and losers. The president's new tax law becomes reality as Americans prepare to file. We'll explain what your tax return check could look like and what you can do right now to boost it.
NBC 10 at Issue starts now.
Good morning. I'm Rosemary Connors for NBC 10 at Issue. We begin with your money. Will you do better or worse when you file your taxes for 2018? Some homeowners in New Jersey may not be thrilled. Others, like people with student loan debt, may breathe a sigh of relief. President Trump signed the new tax plan last December. Most of it will become effective January 1st. It cuts individual income tax rates, doubles the standard deduction, and eliminates personal exemptions. Joining me now is Jamie Hopkins. Jamie is an associate professor of taxation with the American College of Financial Services. Thanks for being with us.
Yeah, thanks for having me on again.
All right, so winners and losers. Let's get right to it.
Yeah, so talking about the tax cuts and kind of who won, who lost. You know, obviously we haven't filed all of our taxes yet, so we're not 100% sure. One thing we do know, corporations did well. So their fiscal year ended and actually tax revenue from the government was down, which means companies actually kept more of their money. We do see right now for individuals, that's what we're kind of more concerned about today. Who's going to win, who's going to lose. There is one rule of thumb that we can kind of say almost across the board, you're going to be in the winner group. That's if you were a standard deduction filer last year and nothing really changed substantially in your life. Well, what happened is the standard deductions essentially got doubled for both single and married filers. So that just means you will be paying less in taxes. Now, if you were an itemized filer, which is about 30 to 40% of the population, that's where we get the question marks. And that's where we get, are you better off? Are you worse off? And what we have to look at there are some of the features of your life. Right? Where do you live? Do you pay high property taxes, high state income taxes, Philadelphia tax, right? All that got capped. So you're not going to be able to deduct as much of that, which means what we're going to see is far fewer itemized filers.
I feel like you are veering us toward talking about the Garden State and New Jersey. So let's go there for a moment.
Yeah, that's a big one. So New Jersey, high state income taxes. So what happened is we used to have something called SALT tax deduction, which was our state and local taxes. And we used to be able to deduct that up and into infinity. Now that got capped at $10,000 a year per filing. So that's a lot. If you're in a state, right, like New Jersey that has high state income taxes and you're paying property taxes, you lost a huge deduction. Now, even in Pennsylvania, if you have a very high net worth property, right, or a lot of land, you're going to be paying high property taxes, not as a percent, but as a total. That's still going to get tapped at $10,000, which means you're going to be paying more in taxes in a lot of those situations. New Jersey, Connecticut, New York, and some areas of Philadelphia are really going to be impacted by that.
What about the mortgage interest deduction, something so many people count on when tax time comes around?
Yeah, so that's good and bad. The good news is most of the stuff stayed the same or was grandfathered in. So if you purchased a home, something we call home acquisition indebtedness, that interest is still deductible for new mortgages up to $750,000 of debt principal. If you had an old mortgage that was $1 million, that still interest is deductible. What got removed is what we call home equity indebtedness. We didn't focus on this too much in the past because they were both deductible. Home equity indebtedness no longer deductible. So what is that? That's line of credit. You took out money from your house to pay off credit cards, to pay for college education, for anything
to buy another property.
Well, so if you bought another property, it might be okay. So did you use it to acquire, substantially improve your property? And it didn't have to be your principal residence. So if you took a line of credit to buy another one, maybe still deductible. But yeah, for any other reason besides purchasing a home, that interest is no longer deductible, regardless of when you took it out. So if it was from 2006, doesn't matter. It's gone. There was no grandfathering in. And the problem for that, for most people, is you're going to get an interest form that you paid on your mortgage. The mortgage company does not tell you whether the interest is deductible. It's all lumped into one number. You as the taxpayer are legally required to track what's deductible and what's not. And so that's a big change for people. People have no idea that that changed. And they're going to go try to deduct that. And if you get audited at some point, you over-deducted something that legally you're not allowed to deduct the interest for anymore.
So how do you track it if you're a responsible taxpayer and you want to do your due diligence, so to speak?
Yeah, so you really have to think about, do I have more than one mortgage or loan amount for my house? And did I use any of that money for something other than, renovating a bathroom or buying a home? That's really what we're thinking about. If you used it for any other purpose when you drew the money out, that's no longer deductible interest. Now that could be a portion, right? You could have taken $300,000 out, $200,000 to buy the home, and $100,000 to pay off college education expenses. Well, 2/3 of your mortgage interest would be deductible and 1/3's not. That's on the individual to track. It's not on the mortgage company. It's not on anyone else but the individual. So hopefully you kept some paperwork. You know what you did with the money.
You mentioned college expenses, college tuition expenses. Can we talk about student loans? Obviously, so many of our viewers have student loans out there. Where do they fit into this scheme?
Yeah, so there's actually good news about that in the sense of, I mentioned before, a lot of people won't be able to itemize anymore because we lost deductions. Well, student loan interest actually is not an itemized deduction. So a lot of people thought, oh, that's gone for me too. It's actually adjustment against your income. So you can still adjust the income by paying the interest on student loans and then still do a standard deduction filing. So that actually wasn't really changed in the tax code. And if you think about it, that person's probably in better tax shape because they were a standard deduction filer last year, can still modify their income based off the student loan interest. So that's actually a pretty good outcome all in all.
Previously, with student loan deductions, you were capped sort of at what your salary was.
Yes.
So if you were making too much money, you couldn't deduct it. So how does that play into?
Yeah, that's still in place. So for single filers and married filing jointly, there's what we call a phase-out range. And so you just have to look at your income and compare it to the two phase-out ranges. Now they change over time. They're indexed, so the numbers do move a little bit. But if you earn $160,000 or so that's actually a good bit above. But for married filing jointly, you won't be able to deduct any of the interest. So our high income earners and upper middle wealth in the area, they're not going to necessarily be able to modify their income for student loan interest.
Same as it was before.
Same as it was before. It didn't change.
All right. So I'm sure we have some viewers at home who are thinking, geez, I wish Jamie could do my taxes or at least sit with me when I get my taxes done, because there's so many new ins and outs to this law, as we said, most of which goes into effect in 2019. So what do you have in terms of tips for our viewers?
Yeah, well, that's a good point. So most of this is in effect now, but will impact our taxes when we pay them in 2019. So the big tip for that is, right, if you were somebody who itemized before, I think it's really important before the end of the year, not before April 15th, before end of year, to talk to a tax professional or financial advisor. The reason is there's things we can do between now and the end of the year that we can't then fix between January 1 and April 15th, especially if you're a small business owner. There's a new tax deduction, never existed. Nobody's ever filed under it before, for pass-through small business owners. So that's your LLCs, your partnerships, your sole proprietorships. That's most of the businesses in the country. There's a new 20% deduction out there for that, and you really do have to pay attention to it. And some of that requires planning before the end of the year. And I've been harping on that, but the message still isn't out there enough.
20% of their revenue for small businesses.
Qualified business income, 20% deduction. Now think about how important that is. Think about if you find out, right, April 15th, that you could have done a little planning between, December and January 1st to get that, and you lost the whole 20% deduction because you didn't do anything. I'd be pretty upset by that. And there's going to be people in that situation. So I want especially that if you're listening, right, you run a small business, right, go talk to a tax professional before the end of the year.
All right, Jamie Hopkins with the American College of Financial Services. As always, great information and insight, and maybe you can come sit with me when I do my tax.
Yeah, hopefully.
Thanks for that, Jamie.
Thanks.